Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar. The status quo in cross-border payments looks to be on the verge of collapse. Collapsological language is, of course, normally associated with catastrophes, as in the end of the world. Few of us, I suspect, are ready yet to welcome the apocalypse. But in the case of cross-border payments, the disappearance of the status quo would actually be something of a blessing. That's not just my opinion. The G20 has made speeding up cross-border payments and making them cheaper, more accessible, and more transparent a major international policy goal. Why have they done that? Well, because some of the poorest people on the planet are losing as much as 20% of payments as low as $200 being sent to them by relatives working abroad. Those cross-border payments don't just affect poor people, they also impose a tax on multinational corporations. According to Oliver Wyman, corporates are paying more than $120 billion a year to move money across borders. And that figure doesn't even include the spreads they pay on FX or the costs of the liquidity buffers they have to maintain with banks all over the world. So just bringing the cost of sending money abroad to the levels paid for sending money to each other domestically would lift a huge transaction cost from the world economy, with beneficial effects not just on people's standard of living, but on growth as well. Which is why, with the help of the Financial Stability Board, the FSB, working through the Committee on Payments and Market Infrastructures, the CPMI, G20 is pursuing a program of 19 building blocks to a better system that aims by 2027 to ensure that 75% of cross-border payments settle within 1 hour, that the global average cost of retail payments does not exceed 1%, and the global average cost of sending that $200 remittance no more than 3%. That 90% of migrant workers will have access to a cross-border electronic remittance payment service, and that all payment service providers, not just banks, will have to disclose total transaction costs and expected time to deliver the funds. 2027 is just 4 years away now, and progress on the 19 building blocks to a better cross-border payment system laid down by the CPMI, to my eye at least, is not just patchy, but in one area, namely payments versus payments, is actually going backwards. And that's because sending money across borders is complicated, not least because currencies as well as value have to be exchanged. Central banks, of course, naturally still think nationally, not internationally. And incumbent banks and payment service providers are, as in any market, proving adept at slowing progress down. But luckily, there are lots of ambitious entrepreneurs armed with good ideas, as well as new technologies that are working out not just how to meet those G20 targets, but to hopefully exceed them. Those ideas include linking central bank digital currency systems, CBDC systems. They include using stable coins, deploying blockchain-based payment versus payment services, growing blockchain-based networks. There are lots of simpler steps which are being taken or could be taken, such as expanding the CLS netting and PVP service to more banks, and certainly more than the 18 currencies CLS currently covers. Then there's lengthening the operating hours of RTGS systems run by central banks, and of course the opening hours of the banks themselves that use those RTGS systems. So there is in fact an explosion of activity in the field of cross-border payments in response to clear regulatory indications that change cannot be delayed much longer. Quite what new systems will emerge from that activity is unknown and inherently unknowable. But what is abundantly clear is that a combination of regulatory, market, technological, and entrepreneurial pressures have placed a ticking time bomb under the status quo. So this feels like, as our title indicates, one of those rare occurrences in the field of innovation at all, let alone innovation in financial services, a change which is, in other words, not just going to be talked about, but actually happen. To help us explore how it might happen, I'm joined by three experts in the field. Chris Hamilton, now principal at Hamilton Platform, his own payments and advisory consulting business, is a former CEO of both the Australian Payments Clearing Association and BankServe Africa, the largest automated clearinghouse in Africa. Marianne Morrow is chairman, CEO, and founder of Ninth Gear, a blockchain-based B2B marketplace that aims to bring operational efficiency and risk mitigation to capital markets by reducing the time it takes to track, to clear, and to settle financial assets. Victoria Cummings is Chief Legal and Regulatory Officer at RTGS.Global, a new financial market infrastructure offering a solution which provides cross-border interbank bilateral PVP atomic settlement 24/7, 365. As always, in addition to our panelists, we have you, our audience, and all four of us encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of your. As always, I won't be saving those questions and comments up to the end, but I'll endeavour to get our panelists to address them as we go along, so that everybody watching and listening can be an integral part of the discussion right from the outset. But I'd like to begin our discussion by returning to the points I raised a minute or two ago, quantitative targets that have been set to achieve faster, cheaper, more accessible and more transparent cross-border payments by 2027, through putting in place those 19 building blocks identified by the CPMI that are needed to actually achieve that. Now, the Financial Stability Board declared in its report back in October 2022 that progress towards those 19 building blocks was going well. The momentum for change had now reached what it called an inflection point. And I'm asking whether our panelists agree with that, because when I read the report, it seemed very largely to consist of surveys, reports, events, and of course, lots of exhortations. And the progress measured inside that report didn't always seem to be that startling. So my question really is this, and perhaps I could put this to you first, Victoria. Do you feel that participants, and in particular the banks, are actually listening and acting, or are they looking to try and slow this process down? And secondly, are the regulators doing enough to stamp out, if that is what the banks are doing, if the banks are behaving in a protectionist manner, are the regulators doing enough to stamp out that behavior?
Thanks very much, Dominic, for having me on the panel. I'm sure we'll have a host of interesting questions to address today. But I guess starting with, the work on the building blocks and how the industry is reacting to that. First of all, I think the initiative from the G20 and the FSB to tackle the problem of enhancing cross-border payments is tremendous. I think definitely worthy of solutions. In terms of the inflection point, yes, I'm very encouraged by the most recent report that said we're moving now from stock taking and analysis and guidance to practical projects to improve systems. I think, whether that plays out, we'll see this year, right? If we're moving into implementation phase now, I think this year really will be pivotal in terms of seeing how that implementation is starting to develop. As to how the banks and industry participants are reacting to that, I think I don't work at a bank, so I can't say firsthand, but I think the banks are exploring these new solutions that are being developed. Obviously, when you're at a bank, you're bombarded probably with every startup or new fintech company that has its better way of doing things, knocking on your door saying, "Look at me." So it's difficult for the banks, I think, to tackle all of the different solutions that are being pitched to them. But I think the banks are looking at these solutions. Obviously, banks have an interest in making money, in saving money, and in complying with regulatory requirements. So if there's something where they think they can achieve one of those three goals, I think it's very much in their interest to pursue it. And as far as I can see, that they are. I think in terms of the central banks, there's still a lot of work to be done, clearly, but hopefully the work that's been done by the FSB and the CPMI and other groups in terms of the building blocks to date have laid a good foundation for that implementation now to happen. And I think it'll be very interesting and exciting to see how that all plays out this year in terms of the new solutions that are being developed to enhance cross-border payments and where those progress to and evolve to as I hope we truly start on that implementation journey.
Now, we've already had a comment from a member of the audience saying if you could give questions in the invitation, that would be fantastic. They were very well crafted. We'd pity to leave them sidelined. I'd like to say to FS, I thought I was asking that first question about whether the pressure for change in cross-border payments is at an inflection point. And maybe, Chris, you could begin to address this for us. You spent this time in Africa, which is an interesting case in point. You've got 50 plus countries at varying stages of developments, but Africa's also acquired this reputation for sort of bypassing the banks with technological innovations of its own, most notably the M-Pesa thing in Kenya. But you may know other examples which can perhaps throw light on this question. Is the FSB right to think we're now at an inflection point? Are we beyond the point of no return with change in cross-border payments?
Yeah, thank you, Dominic, and thanks very much for having me. So let's play with the Africa example for a second. And of course, remember, we're in a very different world now from Victoria's world of large corporate treasuries and significant flows for business reasons. We're in a world where, and it comes back to your introduction, the world's poorest people are trying to get a few bucks home to their families. That's the archetypal example in Africa. Both domestically and cross-border. And you're right. The sad reality is the central banks and the commercial banks have largely stood to one side while solutions are found in a very practical way by new tech and by new companies and by entrepreneurialism, in particular, mobile wallets. You gave the great example of M-Pesa, which is the granddaddy of that world. But there are many, many examples. A glance at the GSMA reporting of the last few years will highlight how many new mobile wallet operators there are, both in Africa, which leads the world in that score, and more generally around the world. And as a consequence, how many new interlinkages between those mobile solutions there are for that very practical purpose of, my son is in Malawi and he's got to send a bit of his salary back to me in order that I can continue to, eat in the village. That's the scenario we're talking about. So, and that is happening quite rapidly. The GSMA is just a factoid from the 2022 report. Cross-border remittances using mobile wallets is up 48%. Now, it's still small in value terms by global standards, but in numerical terms, there are an enormous number of transactions starting to happen that way. So if we include that complicated, messy world, then I think you can argue the FSB's got a point. Things are happening, things are changing, but it's not going to be, at least at this bottom end layer, it's not going to be in a neat, tidy, structured, centralized way. It's going to be a very messy, let 1,000 flowers bloom and some of them will wither and die. It's going to be that kind of world. And you know what? I think that's probably the right way to go in that world right now. And I think the regulatory response ought to be more about opening up and allowing that, taking a level of risk, if you like, because so many new network technologies, so much more connectivity in the world, so much more opportunities for innovative ideas to prosper. With the necessary price that some of them will fail. So yes, there's an interesting world developing out there, particularly in retail cross-border.
Marianne, I don't know whether you want to chip in on this, but you might have an observation from where you sit on whether banks, you've heard Victoria and Chris speak about this, from where you sit, are banks and payment market infrastructures, by which I mean ACHs and RTGS systems, do you sense they are feeling the pressure to change on cross-border payments, or are their focus still very national? Marianne, you seem to have frozen. We may have lost her.
No, I'm here. Can you hear me at all?
Yes, we can hear you.
Okay.
Sorry, you looked as though you were frozen for a minute there.
Okay, I did see it freeze a little bit. So I'm in Silicon Valley and we don't always have the best connectivity. But as I kind of see this, I applaud the initiative, but innovation is really tough. And I am a technologist building products at the intersection of technology, finance, and regulation. But the markets need to be modernized, and we can't just stop that. They're very analog. We've gone from pen and paper to digital incarnations, but they're still not harmonized. So how can we make that happen? So especially in real-time payments and the evolution of payment rails, I think that we can move to real-time because we do, everything on phones now. We're a mobile-first type world, but in the institutional world, there is still breaks, reconciliation errors, and corrections that are just plaguing the back office. And we're using some of the technology from the 1970s. I mean, 50 years ago, technology has moved just so much. So we can't just stop this carousel of movement of money, at least in the FX world, $7.5 trillion per day goes through it. So we can't just stop and reimagine things, but we have solutions that can make a FX transaction go through in less than a minute. So we can track, clear, and settle fix the problem in the pre-trade world. But as we go out, we need to have that embrace of these financial institutions to want to move forward in this innovation. And it is complicated. And as you said, I like the word that you said, patchy, because while I applaud the initiative with these 19 building blocks, it's a lot of work to move that. So when we look from just a pure academic standpoint and say, this is what should happen, putting that in place is a very different type of exercise. And you have to have that complete integration points in order to make that happen. And I don't see that harmonization happening at the rate that I think it should be.
Mm-hmm. Well, we'll come back to those questions of technology, interoperability, and indeed those operational errors you referred to, which are, of course, a source of risk. And one of the things we want to talk about is where risk is actually increasing. And the FSB is pretty clear about this. It's PVP, it's payment versus payment. It's building block number 9, where the original origins of CLS, Herstat risk, lie. And there things seem to be going backwards. And what the FSB is recording here is that PVP payments to reduce that settlement risk have actually decreased since the early 2000s. And the reasons for that are that a lot of the incumbents don't wish to pay the higher costs of that in terms of transaction fees, monthly charges, investment costs of new systems. A lot of them are using third-party service providers, of course. You have to set up default funds. There are loss sharing agreements, all those things. If you set up market infrastructures, they don't want to basically change what they're doing already because it's not worth it. They want to keep their legacy systems. A lot of those existing systems, including CLS, of course, exclude emerging market currencies. But unfortunately, those emerging market currencies are actually becoming more important. This is most obvious in the case of the renminbi, which in the latest BIS triennial survey accounted for 7% of global FX turnover. So it's becoming more and more important. And then there's, of course, all these new PSPs, which Chris was referring to, and which to some extent you, Marianne, and you, Victoria, represent, don't always have access to these real-time gross settlement systems, these central bank money systems. And then again, those real-time gross settlement systems, their operating hours don't always suit user demands. They're certainly not working 24/7, 365, as your propositions are. So the conclusion of the FSB is that nearly a third of deliverable FX turnover in that 2022 survey, that's $2.2 trillion equivalent, is still at risk of failing to settle. That's higher than it was 3 years ago, back in April 2019. So first question is, do you agree that, am I right to focus on PVP as where the problem lies, or is that too narrow a focus? Victoria, well, maybe you could try that first.
So my short answer to that is, I think settlement risk, being as important as it is in FX, is certainly worthy of focus, especially when you see the BIS report saying that there is still nearly a third of deliverable FX turnover subject to settlement risk, 2.2 trillion, as you say, Dominic, of daily FX turnover subject to settlement risk. So I think that is absolutely a topic worthy of discussion and further solutioning. And I don't say that just because I work for a company that is looking to provide a solution in that area, but I think it's pretty obvious there is still a problem to be solved here in terms of PVPFX settlement, and happy to talk more about that. Meantime, I did just want to pick up, Dominic, on your question to Marianne about the pressures that the banks may be feeling. I think just to give 20 seconds on that, I do think that the banks are feeling some pressure from what is happening in the industry now and on the focus to enhance cross-border payments. Certainly, of course, commercial pressures. You've got competitors and new services coming out with their version of how to do payments cheaper, faster, better. That has meant that I think a number of consumers, and if you talk from a consumer or retail perspective, maybe using these other payment rails for moving money between themselves and others, where they might previously have used moving between banks using bank wire services. So I think certainly there are these new ideas and this new tech that is cropping up that is putting commercial pressure on the banks to up their game in terms of what they can provide to folks like you and us to be able to move money to each other quicker and faster. And that's a good thing, I think, right? I mean, that's what spurs innovation and lowers cost and makes us able to do things better. I think there's also pressures on the banks coming from industry movements and initiatives, such as, I think Marianne mentioned this, the reduction to from T+2 to T+1 securities settlement, maybe one day T+0, that inevitably is going to bring with it the need to innovate and will have knock-on impacts such that you need to be able to settle these securities transactions quicker. You're going to need to do your FX quicker. So that, I think, is a good thing as well. And then, you've got the central bank and the regulator pressure. And I think this is going to tie in neatly to our PVP settlement discussion, where, you've got the likes of the BCBS in their FX guidance saying you should be settling PVP because this reduces risk. You've got the Global FX Code of Conduct saying you should be settling PVP because this reduces risk. So there's also that sort of regulatory or principles in the sense of the code pressure to say, as an industry best practice, even if you can't do this in 100% of the cases, you should be making every effort you can, practically speaking, to settle your FX PVP. So there is definitely a drive towards pushing for more PVP FX settlement. The report is saying that there's still a lot of FX that's settling out there without PVP. So the big question is, what can we do in terms of enhancing access and expanding access to PVP settlement? Building block 9, as you say, Dominic, front and center on that.
Chris, before you start talking about PVP, and I'm very keen to hear what you have to say, Chris, could you just address the question from one of our attendees here, specifically about what you said about Africa? I don't know whether you've seen it, but it's for Chris, re Africa. I thought the regulators were trying to force payments back into interbank transfers with gold-plated WTR obligations. Do you understand that question? View on it?
Well, yes, I suppose, and it depends what you mean by regulators. Any question about Africa that says the regulators or the banks is fraught with difficulty because you're talking 50 jurisdictions of enormous ranges of economic development. So let's try and break it up a bit very quickly. East Africa, I just basically disagree with that observation. So the East African central banks love mobile wallets. They have solved an economic problem for them that they were struggling to solve themselves in terms of financial inclusion. They speak in warm and supportive terms of them. Yes, they're regulating them, but not to restrict them in any way, to support them and help them. And the consequence of that is that every major mobile operator that's active in that part of the world has a mobile wallet program, is talking about interlinking it, certainly cross-border to its sister companies in other countries, and talking about expanding it. So I don't see any risk that that's heading back into interbank transfers anytime soon. It's just not going to happen. The genie's out of that particular bottle. Little bit different in other parts of the world, and this may be where the questioner is coming from. In Nigeria, for example, I think you can argue that the regulatory orientation is towards promoting interbank payments and enabling centralized frameworks that support very low cost interbank payments. There are certainly some moves to connect up the different jurisdictions in Africa. There's a proposal from the Exim Bank in Northern Africa to build a sort of entire cross-border African solution, which will be largely bank-based. So it's as usual, it's a melting pot of all sorts of different ideas. But if we come back to the core, who's doing the most good for the least advantaged, you cannot argue that banks are doing that. You certainly can't argue that the card companies are doing that either. It is absolutely a matter of digital remitters offering point-to-point corridor solutions, and it is a matter of mobile wallets providing financial inclusion to people who don't have financial inclusion right now. So I think that's
bank accounts.
And no bank accounts, and no likelihood of having one. Now, having said that, the stats on Kenya, and we're a bit off cross-border, but the stats on Kenya show that mobile wallets are a stepping stone towards bank accounts. So maybe we'll see that graduation as economies mature.
They're the entry-level drug.
Yeah, exactly.
Okay.
Gateway drug.
Let's go back to our question there about where risk in cross-border payments is increasing. And I've, on the basis of what the FSB tells me, have identified this PVP as the problem. That third cash deliveries are not actually settling DBP. Now, is it? Am I framing the problem too narrowly with that? And if I am, is it because the regulators are actually trying to use PVP as a sort of stick with which to force change throughout the system? Because if you do try and settle PVP, it creates all sorts of other problems. You have to be funded for a start. You've also got the fact you're exchanging currencies as well as value, as I said at the outset here. So you've got an FX industry standing in the way there, which is making a lot of money out of these transactions. You've got to change quite a few things, haven't you, to actually achieve PVP? So have I framed it too early? And is it a ploy by regulators to sort of drive change?
I don't know about a ploy. It might be simpler than that. It might just be that everyone likes to trade on past success. So what we've got in the PVP settlement risk example is a disaster followed by a very successful cooperative executed solution in the form of CLS Bank. That's a big win, right? There's not that many big wins like that in this very complicated, messy area that we're talking about now. And so the tendency is to focus on that, and the natural human tendency to focus on that and promote that as being, look, we can do this, It's
we're losing you a bit, Chris.
The climate guys and as the win in this category. Apologies. Can you hear all right?
Yep.
Is it okay now?
Back now? Yes, you're
okay,
fine.
Good. So look, PVP is important, no question. Everything that Victoria just said, absolutely right. Okay, but settlement risk is not the be all and end all of the problem, and indeed strikes different categories of transactions quite differently. So settlement risk at the corporate treasury end of the market is massively important for obvious reasons. Settlement risk at the retail end of the market is not really the biggest problem that you're facing. So using it as the focus is not enormously helpful in solving the problems. It's not wrong. It's just not the most important thing to worry about right now. And that's both a bank and non-bank phenomenon. So there are some neat solutions which haven't really worried about CLS or solving for settlement risk, which central banks have been happy to support. The Thai, Singapore real-time link up between their two real-time systems is a good example of that, right? You've got retail real-time payment solutions, largely bank-driven in both jurisdictions, that have connected together to exchange value between them, right? And that the beauty of that, it's got very little to do with PVP risk, and the amounts of money involved are not huge. So actually, we shouldn't be that worried about PVP risk. What you've got there is a very neat solution for a lot of the complexity of linkages and processing and automation, which otherwise bedevil the field, particularly at the retail end. So it's one of many problems we've got to solve, but not the only one. And as you go further down in ticket size, maybe becomes less important.
Yeah, Dominic, I'm going to jump in here on one thing, and it was something that Victoria had mentioned. So the Securities Industry and Financial Markets Association, SIFMA, is working on a project with DTCC and Deloitte, and it's all about moving the markets to T+1, and it is something that is going to be mandated, and it's scheduled for September of 2024. We had that same thing happen several years ago in 2017. We moved from T+3 down to T+2 in September of 2017, and I think that it is somewhat aspirational that this is going to happen in the fall of 2024. It might get pushed out, but it's a great thing. And I'm keeping a keen eye on that because there is this cascading effect for other types of issuances. When the equities market moves to T+1, the FX market's going to need to coincide with those cycles. So it is a good step in that direction. And it's something that is really critical to have regulators look at this to move the markets to that way, to mandate it.
Right. So PVP can reduce risk, but actually increases it in other areas, notably with liquidity risk, but also you've now got this mismatch between a securities market settling T+1 and an FX market settling T+2. Now, I'd like to move on a little bit to how we can perhaps solve some of these questions. And the obvious one, the one which has got a lot of attention, is linking up the CBDC systems, and Chris has begun to talk about this in reference to the Thai Singapore project, but there have been lots of projects between central banks on linking up CBDCs for cross-border payments. There were sorts of names like Jasper and Ubin and Arbor and Prosperous and Mass and Helvetia and Embridge and Jura, and Embridge is I think the Thai one, Dunbar. We've even got some CBDCs in the marketplace now in the Bahamas, in Eastern Caribbean, in Nigeria, and now in Jamaica as well. So we know that these things can be issued. We know that these things can be used in cross-border transactions, provided the market participants can actually get access and the systems, the CBDC systems, can operate. We've seen papers published about how those systems might interoperate, with single entry, with bilateral links, with hub and spoke models. The real problem, of course, we don't actually have CBDCs in all the major currencies or major currency pairs yet. So,
or any of them, actually.
Or any of them,
except Chinese, except renminbi.
So if I said to you, is linking CBD systems a solution, the long-term solution here to these high costs, slow speeds, lack of transparency, would you say yes, or would you say we have to wait and see? Chris?
Yeah, okay. So maybe, but not because the tech is somehow fundamentally better for cross-border. But because it is being thought about and designed and built in an era when this is a problem that people are thinking about. So the benefit we have here is that the proponents of CBDC have the opportunity to build the world in a more greenfields way than they normally get. So let's go back a step and unpack that. What's CBDC for? Why all the excitement? It's not about cross-border fundamentally. It's not primarily about that.
The OMFIF survey, which they ran last year of central banks, actually says that there was a clear majority there that actually cross-border payments were a very low priority for central banks considering CBDC. So you're right about that.
Absolutely.
Yep.
Absolutely. If you go and listen to the discussions about that in the BIS, in central banks all over the world, it's not about that. And it is about a couple of fundamental things, though. One of them is the inevitable impending disappearance of folding money and the need for central banks to manage monetary policy in a world without folding money. That's actually probably the single biggest reason for CBDC, and we can go into detail about why that is some other webinar, I guess. But so, it's primarily a very domestic, very national economy kind of concern that is driving most CBDC inquiries. But having said that, if you're going to do it and a bunch of your friends are going to do it at the same time, why not try and get some coordination of design? And that's where projects like Dunbar come from. Dunbar's really interesting for a couple of reasons. It's I think 8 central banks talking about how to all do CBDC on a common interoperable technical platform, right? So it solves for everything except FX. So the FX problem is still there in the sense that each of these CBDCs is a different national currency, right? So you're still going to have an FX conversion problem and liquidity issues associated with that and price issues associated with that. But if you can solve everything else in terms of how to move these things around, how to send the messages and receive them, how to minimize errors, which potentially you can, then you can start to see how there might be very serious benefit there. But it comes at pretty major cost. All of those central banks would then have to maintain in lockstep their technical solutions for CBDC. So that's okay at a point in time if you're starting out, but the economic pressures on them not doing that in the future, I would have thought would be pretty major, because they have to serve their economies first and the cross-border world second. So I'm a bit askance about whether that's going to work long term and whether we might not be buying ourselves a longer term challenge in keeping these things in lockstep if we start that way. Right now, every CBDC solution that's actually in the market is completely different in technological terms. There's not really a useful common element there partly because they're solving specific domestic concerns. Yeah. So we've got a long way to go if that's the answer, is the short answer.
Yeah. Okay. Well, Dan Feeney in our audience has put the question much more simply than I managed to do. He said, when will real-time payment systems connect across jurisdictions to eclipse correspondent banking?
Brutal but fair, yes.
Yeah. Victoria, what's your view on Dan's question, but also what's your view on the CBDs? I know, Marianne, you've got some thoughts on this too, so chip in afterwards. But what's your view? Are CBDC link-ups a long way off? And what about Dan's question here? I mean, it amounts to the same thing. It's just you're using RTGS systems today to hook them up, as opposed to CBDCs, which we might have tomorrow, and hooking them up instead.
Yeah, I think on the CBDC question, Dominic, I would say wait and see. At RTGS Global, I think, we can provide a very efficient and safe and elegant solution for cross-border FX settlements and PVP settlement without the use of CBDC. So I don't think that CBDC is necessarily...
And without correspondent banks as well, Victoria?
I'm sorry, Dominic?
And without correspondent banks as well?
Well, without correspondent banks as we know them in the form today, where you're reliant on credit with your correspondent bank or parking money at your correspondent bank, and therefore incurring all of the costs and risks that come with that. But I think, I'm certainly keeping an eye on what's going on in the CBDC space, very interested in these various projects. And particularly for me, my focus is more on the wholesale CBDC. I have plenty of interest in retail CBDC too, just from a personal level. But in terms of wholesale CBDC cross-border initiatives, I'm waiting to see whether those really can provide something better than what can be accomplished today without this new wholesale CBDC. I think I agree with Chris, the idea that, if we just all implement a CBDC, then we can solve for everything. No, that there's obviously a lot of work and a lot of probably as many challenges that get raised by introducing CBDCs into the mix than not. But I think the jury is somewhat still out on CBDCs. That we're right in the midst of a number of projects that Chris has cited in that respect. I think obviously a lot of attention is being given to domestic CBDC and retail CBDC because I guess, can we do this domestically before we start talking about whether we can exchange our CBDC for their CBDC? But yeah, I mean, clearly it's getting a lot of press time at the moment, all of these CBDC projects, mainly retail, but also in some regard.
Okay. Now, Marianne, I don't know whether you want to add to that. It seems that CBDCs are not here; they're not going to be here for a while, and to involve them in cross-border payments would take a huge amount of collaboration and cooperation, logically, politically, in every other possible way. Is it more sensible for you to talk a little bit about how the existing system can raise its game to improve cross-border payments, rather than hoping that CBDCs will ride to the rescue?
Yeah, so really quickly on
ahead.
CBDCs, I'm going to put something in the chat, and perhaps you can put this with the audience. This is how I keep track of what's happening in the CBDC world, because there's just so many projects that are happening. So Atlantic Council has put together this tracker on CBDCs, and it's the best that I've seen. So I take a look at that on a regular basis.
It's very good. Yeah.
Yeah, and so that's part one. So if you could share that with the audience, I'd appreciate it. Second, with regards to CBDCs, I'm most closely, because I'm in the US, tied to the digital dollar project here. And it's being led by some really great folks, Daniel Gorfine and Chris Giancarlo, who are with the CFTC. And they say, if we can send a man to the moon, why can't we send the dollar to cyberspace? It is a complicated thing. And when we do it, because so much of every type of FX transaction goes through, 88% is still through the US dollar, because it's not one of both sides, one side of the equation. So it is just such an enormous project, and it is 5 to 7 years out. It is not something that's going to be happening anytime soon. And the interoperability for these types of interactions is just so critical. So if you're building on different structures, you need to be able to pass information from a meta layer in between different systems. And how can we do that in real time? So the evolution of finance is to have everything be in real time. And we're just not there yet, because there is this friction with points of reconciliation between those two different parties. So I don't think that CBDCs are going to be the answer in the short term. it is aspirational, but I think that there are other things that we can do to alleviate some of these burdens and to move the money faster so that commerce can be conducted in a much faster way.
Can I suggest to you what some of those things might be? These existing service providers, what they could do. The correspondent banks could improve what they do. Perhaps we could get more of them. We could expand CLS to encompass more currencies to make it easier for banks to join it. There's a very small number of banks there who tend to service all the other sub-banks, as it were. We could admit non-bank payment service providers to RTGS systems. We could extend the operating hours of central banks, and indeed the local banks themselves could start working round the clock. We've had an interesting question here, because this I think opens up something else which is very interesting for us. A member of the audience said, did central banks make a misstep in hardening their hearts against netting and putting all their eggs in the gas-guzzling CLS basket? That strikes us a bit harsh on CLS, whose main benefit to banks is, I think, the netting. But it touches on a very important point here. One way in which the existing system could be vastly improved would, of course, be multilateral netting, which would reduce that liquidity risk, which we touched upon earlier, which you need for pre-funding. And you could even start to introduce netting of payments against CCPs, which is what they're trying to do in Brazil and in India now. So I've run through a list of things here, Mary-Ann, rather unfairly. I'm sure you can't remember what they are, but maybe you could talk about netting. Is netting an important part of the answer here?
I think that netting is up at one of the very important critical pieces. I mean, you said so many things so quickly, Dominic.
Sorry.
Each
Yes.
one of those items requires significant focus. And I think that expanding CLS from 18 currencies to, it's only 10% of the currencies could be, something that is a really great idea. However, CLS is a closed ecosystem and you only have 80 different participants in there, and it's expensive. So that really doesn't bode well for some of the smaller participants. So I think it's one of many things that can be done, but it needs to have this cross-functional industry focus in order to make it happen.
Mm-hmm. Yeah, I think I totally agree with Mary-Ann on that. The list of things that you rattled off, Dominic, I think for most, if not all of them, the quick answer to that is easier said than done. But that's not to say that you shouldn't try to tackle some of these things. And they are being tackled. I mean, some of them form part of the building blocks of the roadmap. I think to Dan's question, when will real-time payment systems connect across jurisdictions to eclipse correspondent banking? There is work being done to explore whether you can somehow synchronously connect real-time payment systems that exist in different countries, where you just make sure what happens there also happens there at the same time. Again, I think easier said than done. Obviously, connecting to payment systems requires a tremendous amount of coordination between the two. And then if you start adding in more than two, everything that comes with that, I don't know that even achieving that would necessarily eclipse correspondent banking, because connecting the real-time payment systems means that the participants in those payment systems, could move funds between themselves synchronously with movement on the other side, but it's still limited to those participants in the payment systems and those with the central bank accounts that are tied to the movement. So I don't know that I would understand how that would eclipse correspondent banking, but certainly I think one of the building blocks is interlinkages between payment systems, and that is being explored. But I think the comment about all of the eggs in, I'm certainly not going to comment on whether CLS is a gas guzzling basket. CLS performs a very important function for the industry, and obviously was an initiative born out of the Herstat situation. And I think CLS does what it does very well. But however, certainly, as anyone would point out, and clearly from the BIS report, not all FX in the world is settled through CLS. So some of it can be settled through CLS, and for whatever reason, it's not. but also there's a vast amount that is not settled through CLS because it's not a CLS currency, or it's settled between banks or participants that are not CLS members or third-party members. So clearly there is still a lot of opportunity there for FX to be more safely settled. And if there's new innovators that can come in and do that and provide that service potentially as an accompaniment to CLS, even if it's, you know, gross settlements, CLS does the multilateral netting, it does very well. But even if there's something that can be offered to cover those non-CLS currencies, to provide for entities that don't have access to CLS or don't want access to CLS for one reason or another, I think they could sit side by side, so that, you know, you cover as much of the FX market as possible, and bring that 2.2 trillion number down as much as you can.
Now, Victoria, you referred to innovators. Now, you're one of those innovators. So you've got, you know, private sector ventures. Marianne is running another one at Ninth Gear. You at RTGS, Not Global, are one, and there's Baton and others. You know, one of the questions which our audience is interested in hearing about is whether ventures like yours are going to sort of overtake the incumbent service providers, obviously most particularly the correspondent banking systems. Is that a realistic goal, that you can actually build a whole new system alongside the status quo and kind of transfer business onto it slowly over time and let the old wither away? Or do the incumbents have so much legacy and so much weight behind them that they're very difficult to displace, and you kind of have to ginger up their game and find a niche rather than replace what they're doing? I'm sorry, it's a very complicated question here, but are you looking to overthrow the system, or looking to adapt it, or change it, or replace it?
Is that for me, or I'm happy for
That's
others?
For you, and then I'd like Marianne to address it as well.
Yeah, I think, like I said, the at least if we're talking about PVPFX settlement, the incumbent does what it does very well, and it does, you know, cover the majority of the most heavily, or all of the most heavily traded currencies in the world. I think certainly from our perspective, we're not going to come in tomorrow and be replacing CLS, at least with RTGS Global. You know, our settlements are not multilaterally netted like CLS is. They're gross settlements, instant 24/7, 365, but gross. I think for the likes of us, and potentially, you know, there were 10 plus other innovators mentioned, I think, in that CPMI paper that were looking at how to expand PVP settlement. You know, at least in the short term, potentially we're there to fill the gaps, to provide PVPFX settlement for those currencies and for those institutions that do not have access to PVP settlement today. That to me is sort of the most urgent problem. But then, you know, in addition to that, maybe there are some needs that are unmet by CLS. They're in CLS currencies, but they're not met by CLS. The settlement needs to happen on a Saturday or at a certain time. And there is some requirement to use a different system that has a different model and that solutions and services different needs. So I really think, you know, are we going to end up with 100 different settlement systems in the future? Probably not. But I think we could have some sitting sort of alongside each other, each providing the users with the capabilities and the use cases that they need, that give users a bit more choice and a bit more opportunity to, you know, address their needs through these solutions existing, as opposed to really, as we say today, I think quite limited scope in terms of how you can affect PVP settlement for FX transactions.
Mm-hmm.
So what Victoria had mentioned is that in July, the Bank for International Settlement put out a consultative report on capital payments and markets infrastructures. And of the 16 firms that were named, 11 were identified as concrete solutions. Victoria's firm, RTGS, and as well as Ninth Gear, which is who I represent, both were named concrete solutions. So there are many different ways to put real-time settlement into the market so that it can be immediate, latency-free, and some of it is technological advancement, but other is a coordination and more of a network effect. So as we've put our solution forward, we have built it as business as usual, because we cannot just stop the markets and introduce something new. We have to make it really easy. It's not a rip and replace exercise. So it is a slow progression. And then at some point we see that there will be a snowballing, and we'll be wondering, how did we ever do this on T plus, 2, 3, 4, 5, 6. I mean, when I entered the market, it was very different, and it was multiple days. But if you do have a holiday or golden week in Asia, I mean, things just stop and slow down. So how can we make this so that it is in the moment? It is possible. We've done 2 successful proofs of concepts, and we know that we can make a settlement go through in less than a minute. So the question is now, how do we take this and implement this into the market? And it does take a bit of time for new methods to have adoption, as well as absorbing all the new methods to put it forward.
I'd like to, we're into our last 10 minutes now, I'd like to raise the question about what role blockchain has to play in this, and not just in relation to what Marianne and Victoria are doing, but there's some quite far-reaching ideas out there to create sort of multilateral netted PvP blockchain networks, as opposed to our present system of centralized multilateral netted PvP systems like CLS. And let me just share with you, I'm conscious I'm sort of producing, let me share some ideas with you. CBDCs are obviously one instance of that through some of those projects we referred to, Jura, Cedar, Meridian, Mariana, but also the party or blockchain-based network in Asia, which is being governed by DBS, JP Morgan Standard Chartered, and Temasek out of, so are basically exchanging value in commercial bank money, but it's blockchain-based. Citi has put forward this very far-reaching idea of a regulated internet of value, in which all forms of regulated money, both central bank money and commercial bank money, including stable coins, including various forms of e-money, these get tokenized on or network of blockchain networks, and they're used to settle transactions around the clock. Interesting idea, but it's still just an idea. Then there's this regulated liability network. It's a proof of concept led by the New York Fed, in which tokenized central bank reserves and commercial bank money deposits are used to settle transactions between bank chain network. We've had this idea put forward by almost in an academic sense for on-chain settlement, on-blockchain settlement using stable coins, and actually adapting the liquidity provision model from the decentralized finance markets, that's automated market makers. So the whole thing becomes algorithmic. China is pursuing a blockchain-based universal digital payments network. So there are some very far-reaching ideas out there based upon blockchain. Chris, are you a blockchain believer or are you a blockchain skeptic when it comes to assessing the potential value of these blockchain-based networks solving cross-border payment problems?
Oh, you're going to get me hate mail now. I am not inherently, I'm a blockchain skeptic, but not in the sense that I don't think the technology has got some very interesting applications, but in the sense that I think people often mistake the technology for the business solution. And I think it's unhelpful to talk about the technology as if it automatically solves the business problem. It may be used sometimes to solve a business problem. Quite often the assumption is made when a new service comes out that it's using a particular technology when it's not. Now, I've read quite a big debate about whether the Chinese CBDC is actually using blockchain or not, and the Chinese central bank is being
the answer is not, I think.
Tight-lipped as it would.
I understand
they have shared
the code. They have shared the code with the BIS. Yeah, not.
Okay, there you go. So, and it's pretty clear that there is no inherent need to use a blockchain, with a couple of caveats to that we haven't got time to go into. The key points I think to think about have already been mentioned by others in this conversation, which are tokenization and atomic settlement. If you can get those 2 ideas and apply them rigorously, then you solve some difficult business problems that we have today. You might use a blockchain to do that, but you don't necessarily have to. And I think there are quite a few examples where those things are being achieved where that is not being done now. So the blockchain technology tends to obscure the conversation rather than clarify it. So I think there are a lot of interesting things being done, but I always want to come back to what's the business solution that's being proposed to a business problem, and then worry about whether the technology is necessary to deliver that sort of later. And so the key point for cross-border is, if you can bring about frictionless atomic settlement, that is line by line, every individual transaction settled instantly, at the same time as you are tokenizing on both sides to facilitate movement of the asset, then I think you've got some interesting stuff to play with. But like all of these things, the network effects are incredibly powerful. So it really matters as to how many people join your particular solution, right? And if you can't get everybody to join your solution, then it's just another solution.
Mm-hmm. Marian, just on a very narrow question, are the technical constraints of lack of speed, lack of scalability a problem in pushing blockchain networks into the cross-border payments area?
No, because I don't believe that it's a DeFi issue. So there's no gas cost when you use a private permission blockchain. You still need to obfuscate trades because you can't just show the world what you're doing. If you look at the issue, it's not just atomic settlement, but if you deconstruct these transactions into trading and credit, you need a capacity type of module to ensure that you don't have the double spend. So if you look at what blockchain provides, you look at things like immutability, single source of truth. So you're all looking at one ledger that can't be changed, but also the double spend problem. So if I'm trading with Victoria and I've traded and given that to Victoria and she has it, I can't then go again and then trade that same item without delivery over to Chris. So blockchain does have a really elegant way of solving that issue so that you can achieve atomic settlement, but also that you don't have the double spend problem. And I do think that technology can advance it if applied in the correct way.
Is atomic settlement the same thing as PvP when push comes to shove? It's technically different, but you get the same result. You both have to be pre-funded, payment versus payment. Payment dies if the one side isn't there.
I think fundamentally it's different, but this is a much longer conversation with some math involved.
Yeah, you can do PvP without atomic settlement, but you can also do it through atomic settlement. I think that's the way I would answer that question. But anyway, it's probably a kind of a bit dry as an argument. I think Marianne and I might have to have a bigger debate about blockchain someday, because I'm not sure I agree. But
we can arm wrestle that one, Chris. I got it.
Yeah, we can. Yeah.
So we're into our last few minutes now, and I'd just like to ask a question: what regulators could actually do to help push this process along? Because everything I've heard this afternoon indicates we're going to end up with a more complicated system rather than a less complicated one, and moving to things like linking up CBDC systems entails massive quantities of cross-border collaboration, which seem very unrealistic. So you're going to have this melange of payment providers, payment systems within countries, let alone across borders. I was talking to one blockchain-based payments innovator in London who told me that they were putting together a directory of payment service providers, and they'd already got up to 25,000 providers on a global scale. So simply making sense of this and regulating this is going to be quite difficult. What do you think regulators should do? What can they do to help move this process along? Marianne.
So we've made a lot of friends with the regulators because I think that hairstart risk or settlement risk is unnecessary, and they applaud that. So they like the fact that we're moving through to a fully automated, fully programmable way of moving money. What they can do is help mandate the change in this fully functional world where we can make it incredibly less friction based. There's so much friction in the points of contact, and there's just too many hands in the pot. So if we can eliminate many of the steps and just release the flow of money, I think the regulators will support that, and we need their support in order to mandate this going forward.
Do you think they're going to be positive on stable coin? Could they be more positive on stable coins? They're starting to regulate those.
I don't think that stable coins are the way forward. I don't think stable coins are that stable, and there's just too much leverage, and they're too hard to audit. I think some of them are just complete frauds. So we're going to see a lot of, we're going to continue to see the continuation of what it was happening last year. And a lot of the noise is going to go out of the market, and we're going to see this network effects of what blockchain can do to move it forward. So I'm glad that some of that stuff is happening, because it just takes a lot of that noise off the table. And then the real technologists and the real strategists can move this forward.
Could, to the point Chris raised, could regulators be helpful in regulating digital assets, by which I mean tokenized assets, really, not the cryptocurrency thing, which is outside the regulatory perimeter, but actually being more positive about applications of blockchain technology to, say, the securities markets?
Yes, and there are a lot of former regulators, at least in the US, like Jay Clayton, Chris Giancarlo, Brian Brooks, that are working to move that forward.
Mm-hmm.
Yeah. So, but let's just, the instincts in a lot of central banks are right, in the sense that it's very, let's say, fashionable right now to have a sandbox where you invite new technology players to come in and test out the technology so the central bank can understand it and it can see whether it can be licensed within the existing framework or it needs something new. So that's a positive development to be encouraged. Unfortunately, the hit rate on that stuff isn't fantastic. People find it difficult to work out how to use that effectively to get a good outcome. But your point about melange is absolutely right. We are at least at the retail end, and I'm less clear on what's going to happen at the wholesale end. At least at the retail end, we're going to have multiple commercial solutions in this space. So the regulator's job here is not to try and second guess that, but to quickly and sensibly skill itself up on what each new solution is as it comes along, because the market's going to keep throwing them up, and be prepared to take a level of risk to see which ones pan out and which don't. That's hard for a regulator, but I think that's the way it's going to go.
Dan Feeney has made my favorite contribution here. He says, who will govern digital identity and cross-border trade to reduce fraud and crime? Banks, governments, central banks, regulators, or
wow, there you go.
Well, what he means,
no one's in charge.
Well, that is the problem. Probably there's those decentralized identities, that self-sovereign identities, could make cross-border payments easier, as well as cross-border trade finance easier. And reduce the barriers to adopting these technologies, because you've got all these correspondent banks retreating, and trade finance banks retreating from the marketplace because they have no idea who the clients of their client are. And so if you had these digital identity, it would massively reduce the cost of all these pointless processes which are running, people, data vendors making a lot of money out of selling useless data to people. Banks, insurance companies, asset managers, and others to check identities. I'd have thought digital IDs really are part of the solution. But on the other hand, when I read the FSB report, it seems to me digital IDs are dead, basically. There was a plan a couple of years ago for the South Pacific central banks were going to introduce them. That project came to nothing, and nobody else has picked it up. So is the answer what Chris has just given us, that nobody wants to drive digital identities, so they will never happen, despite their massive cost saving and efficiency enhancing potential? Yeah, that is the answer, is it?
I think a global organized digital identity will be hard to implement. I'm not an expert on digital identity, but that's just my gut.
Wouldn't it be great though?
Yeah.
Just not
well, we think so, Dan. We think they're a great idea, but it's very difficult to see who would drive them, particularly after that South Pacific project hit the buffers, as it were. Anyway, we're over time, so let's close our discussion with perhaps just one final question, and it's a question, I suppose, in two parts, and you can take whichever part you like as a panelist. One is that one of the forces of change in this area we haven't talked much about is the geopolitical. You see Russia, you see China looking to create alternatives to the status quo, and particularly to reduce their dependence on SWIFT. That is a factor in change from one very large economy and one other economy. And then the second half of the question is, was I right to say at the outset and in the title of this discussion that actually this whole cross-border payments industry is on the cusp of a revolution which is going to change the way things are done? Now, take either half of that question, whichever takes your fancy best. Chris, perhaps you could start us off. Russia, China,
okay,
revolution.
So second part of your question, kind of yes, but it's been going on for a while. But it's coming bottom up, so based on the comments that I made earlier. On the China question, this is a very significant issue, particularly for developing economies, because one of the key dynamics for central banks in developing economies will be defending their monetary sovereignty. That is going to be a very significant issue for them in many ways, and it's one of the things that is driving their inquiry into CBDC, by the way. Because what you do not want to see if you're in a developing economy and trying to run its monetary policy is everybody starting to use a US CBDC to do local transactions. That means you have lost control of your economy, full stop, right? So you can see that being eventually a very significant issue. And of course, the Chinese are out ahead of the Americans by about 5 to 10 years on this issue. And so that's going to be a challenge, particularly in Africa. How it'll play out, I don't know, but I'm going to watch with great interest. So watch that space. That could upend a lot of what we've said today.
Marianne?
I'm going to answer the second part of your question. I think that the revolution is upon us, and it's really just so wonderful to be at this intersection of finance and technology. Real-time settlement and payments seem so obvious, and there is this big transformation that's happening. I think that we are going to be moving to a latency-free, fully automated, fully programmable way of moving money.
And your best agents of help in that process are the regulators or the underlying customers of the banks?
I think that you need to have a framework and fabric that involves both the startups, so fintechs, the existing players, as well as the regulators. Everything needs to be woven together.
Victoria, last word from you. Is it Russia and China? They're going to upend the status quo, or is the status quo already being upended by a mixture of technology and entrepreneurialism?
Yeah, I don't really have anything to add to Chris on the geopolitical elements, but I think, I would certainly hope that we're in the midst of a revolution, or at least massive evolution, in enhancing cross-border payments. I mean, that is the goal of the roadmap. And I very much hope that the efforts on the 19 building blocks culminates in something game-changing and really meaningful to drive the industry forward and to be more modern, more improved, cheaper, faster, better. All the goals I really hope get achieved from the roadmap. I think in terms of how the central banks and the regulators and the international bodies can help, I think, as Marianne says, engaging with the industry, including the startup companies that are, there's a call to action to come up with ideas for how to improve things. The startup companies are working long and hard to do that. So involve the industry, involve the startup companies in your deliberations and in your projects and in your initiatives. We've been tremendously lucky to be involved in Building Block 9 and engaging with the CPMI and the industry groups that runs on that. I think that is great. You need to get that input and feedback and ideas and concerns from the industry. And then, I think lastly, I would just say as well, central banks and regulators have an international mindset. When you're innovating and improving and enhancing domestic systems, imagine this in an interconnected world where your currency is moving alongside a movement in another currency. If you take that global perspective and cross-border perspective as you're innovating domestically, I think that'll set you up for the cross-border and not have to kind of tackle that as a new problem once your domestic improvements are done.
Right. So it must be a world revolution, but one based rather oddly not on confrontation, but on collaboration and cooperation. Thank you, Victoria, for that final thought. We must stop now as we've run over time. As always, I feel that we've been scratching the surface of this and have identified lots of subjects which require treatment all on their own, at least an hour or two. But we don't have time to do that now. So I'd just like to thank our panelists, Chris Hamilton from Hamilton Platform, Marianne Morrow from Ninth Gear Technologies, and Victoria Cummings from RTGS.global. I'd also like to thank you, our audience, for your questions and your comments. Here at Future of Finance, our next webinar is not going to take place next week as planned, but it'll take place next month. In it, we will be exploring a subject we've touched upon repeatedly today, central bank digital currencies, or CBDCs, and in particular, how CBDCs might actually happen in the major currencies. And we will advise you of the revised date for that event as soon as we have settled upon it. And I hope that many of you will join us on the day when it happens. But for now, it's goodbye from